Wall Street is celebrating. Stocks are currently trading near record highs, and enthusiasm for artificial intelligence is driving almost all of that optimism. Nvidia's latest market outlook recently helped revive technology stocks, renewing confidence that heavy corporate spending on AI is going to continue across the board. But when the market climbs this high, it creates a structural vulnerability. Investors are paying a premium for these shares, which means they need exceptionally strong corporate earnings and flawless economic growth just to justify the prices. We already saw what happens when reality falls short of perfection. Marvell Technology faced a sharp sell-off the moment investors grew concerned about exactly when their AI-related revenue would actually materialize. The market is moving past the broad idea that AI will simply change the world and is now demanding immediate, measurable profits. Because investors are becoming highly selective, the entire rally is exposed to the slightest macroeconomic shock. That shock could easily come from the Federal Reserve, which is still actively fighting to bring inflation down without damaging the labor market. At the recent Jackson Hole Symposium, the Federal Reserve's Kevin Warsh made the central bank's position clear. He emphasized a strict commitment to hitting their 2% inflation target, even if that means keeping borrowing costs restrictive. Those remarks instantly altered how traders view the upcoming September meeting. The market-implied odds of a September interest rate hike jumped from roughly 35% to well past 55%. To see how serious this threat is, we have to look at the 2-year U.S. Treasury yield. This specific bond is highly sensitive to Federal Reserve policy, acting as an early warning system for what investors expect borrowing costs to do before the stock market fully reacts. As this graph shows, right after Warsh's speech, the 2-year yield moved sharply higher. Traders are actively increasing their bets on higher borrowing costs. So while stock investors are busy celebrating record valuations, the bond market is aggressively bracing for a collision with higher interest rates. The tension between these two markets will likely break with the release of the next U.S. Department of Labor jobs report. This decision tree maps out the market's paths. Economists expect 45,000 new jobs. If hiring comes in much stronger, investors worry the economy is running too hot, pressuring the Fed to keep rates high. Borrowing remains expensive, bond yields rise, and highly priced growth stocks face downward pressure. Because the market requires perfect conditions to maintain its current valuations, traditional good news for the American worker threatens to crash the corporate stock rally. But what if hiring is significantly weaker than the 45,000 baseline? This introduces a counterintuitive dynamic where bad economic news becomes good news. If labor data proves the economy is slowing, it reduces expectations for aggressive Fed tightening. The market assumes easier monetary policy, and investors buy in. What Wall Street is really hoping for is the middle path. This balanced scenario requires moderate job growth, no unemployment spikes, and lower inflation. This gives the Federal Reserve room to hold rates steady. Without the threat of a hike, the AI-driven stock rally can continue unhindered. Market participants are now waiting to see if U.S. employment performance falls within the specific range required to sustain current stock prices. Because markets can turn in a matter of seconds, trying to build a long-term financial strategy around predicting a single Federal Reserve meeting is dangerous. As this diagram illustrates, investors are dealing with 5 distinct macroeconomic forces colliding at the exact same time: inflation, interest rates, employment, corporate earnings, and valuations. They are completely connected. A sudden shift in the employment data immediately forces the rest to aggressively realign. Ultimately, Wall Street's trillion-dollar technology valuations are currently entirely dependent on the continuous stability of Main Street labor. The trajectory of the stock market currently depends on the paycheck and stability of the American worker. Tracking these labor reports provides a direct window into how the Federal Reserve will manage interest rates in the months ahead.